Welcome to the Capital News. I am your host, Alex Caritas. Today is April 3rd, 2019. Thank you so much for joining me. I hope everyone is doing well today. Let's get straight into the economic news for the day. So the S&P closed up 6 points. The Dow was up 39. NASDAQ was up 47. And the Russell 2000, the small cap index, closed up 7.5 points. Oil remains around $62.50. Gold holds at $1,296 an ounce, and silver still hovers around $15 an ounce. The 10-year Treasury continued its ascent and now sits at 2.517%. So quite the gain we have seen on the 10-year Treasury yield in really only the past week and a half, which was at 2.3 something just a few days ago. Now it's at 2.517%. So quite the reversal on the 10-year Treasury. A flight more towards not safety, but now towards more risk on. Risk on. So now there's been more of a surge into equities. Makes no sense, given the underlying economic data that we see day in and day out. But we're in a financial world of Oz, so it makes entirely, completely good, logical sense. We're just going to continue to see this until we don't. Until we don't. And that's the best way I can phrase it. We will continue to see this market go up, up, and up until we don't. Because I can't predict day-to-day movements. I'm not going to attempt to do so. Because it's just too crazy. And you're just not going to be that accurate. So I'm not going to set myself up for that type of failure. Now, I do want to have a discussion further on some data. Yesterday we spoke about the federal government's tax receipts and how perhaps that might be an indicator for recessions, or that we're in a recession or something of the like. Why? Well, because typically when you have negative percentage growth year over year, month over month, quarter over quarter, we were looking at quarterly data, it means you're in a recession. Well, we have just had 5 consecutive quarters, so over 1 year of negative growth quarter over quarter, and we're not technically or officially in a recession. This is looking at data going back to 1980 because I wanted to see how well this data stood up to history. Well, it was pretty good all that time. Now we're not officially or technically in a recession, but we'll see if this becomes some sort of leading indicator to say, well, we're headed into one. Because remember, folks, a recession is a lagging indicator. We're not going to be told that we're in a recession until months after the data comes out and is reported to us by our government officials. So the data that we're going to look at today has to deal with pretty much summing up this house of cards economy in which we live. So what I'm looking at here today is the Wilshire 5000 price index, which is basically the total stock market, against the St. Louis adjusted monetary base. So the reason why I'm picking the monetary base is because this has to do with pretty much being a good proxy for quantitative easing. Because you have to remember, folks, we had 3 rounds of quantitative easing. So if you're looking at this graph of the monetary base, you see throughout the entirety of this country's history pretty much, and I think this data goes way back, but I cut it off. I'm looking basically back from the early 1990s. But you basically have a flat line hovering well below billions of dollars. And then come the great financial recession of 2008, 2009. Well, we had the invention of quantitative easing. And you can see it right in the data if you graph it out. It is a step-like graph. Quantitative easing 1. Boom. Now you're in the trillions. You're going up into trillions. It teeters off, plateaus a little bit. Well, that fix wasn't big enough for the crack addicts on Wall Street. So Ben Bernanke and company at the Federal Reserve said, boom, let's do it again. Quantitative easing 2. Another line straight up. Then that plateaus for a little bit. The crybabies cry on Wall Street, and boom, quantitative easing number 3. An even bigger dose. An even bigger dose. And then that starts to level off. But when you graph this against the stock market, the Wilshire 5000, you see clearly, without a doubt in your mind, that this entire stock market is in a bubble. It has been because of reflation and inflation by the Federal Reserve. Money printing has kept this stock market going until it doesn't. Again, with that saying, it will work until it doesn't. And that's where we are right now. I mean, it's disgusting. I'm looking at these graphs right now. Charts lapped over over each other here. And it's just, I mean, it really, from somebody who looks at this stuff all the time, it takes the words out of my mouth. I can't even think straight. Because people think that this is such a great economy. No, it isn't. Go look at this graph. This is why I'm going to be doing more stuff on YouTube with these videos so you guys can actually see what I'm looking at. Those things will be coming, don't worry. But this is, it's sickening. There's no other way to describe it. This is why you have people like candidate Trump at the time or Stanley Druckenmiller, you know, these guys coming out and saying, look, this has been the biggest wealth transfer in the history of mankind. And it has been. It has been, because this has been inflation. This is theft. This is another form of taxation that takes all of this money away from the middle class and sends it upstairs to the 1%. And I'm not about class welfare or warfare. You know this. But when it's done fraudulently, oh yeah, I'm going to be all over this. And this is most definitely a fraud that you and I are paying for. Now, if you were smart and you said, okay, well, I'm going to be in this market and stay invested after the Great Recession, if you could, you've made out. You have. Now, I'm basically saying, you know, how greedy do you want to get? Because if you stayed invested, you should have made some good money. How much further can this go? We had the 180 policy U-turn back in the fourth quarter of 2018. We know this. We talk about that all the time. But if you actually look at it and see what's going on here, this entire economy is in a bubble. Where is the real growth? And here's another scary thing to look at. Oh, what's the website? Shadowstats.com. This is put together by an economist who looks at how the government used to calculate data, used to calculate unemployment, GDP, inflation, money supply, all that type of stuff. He basically looks at two different benchmarks. He looks at how it was calculated in 1980 and how it was looked at in 1990, and then he posts that and graphs that against what the government says they do today. Well, it's frightening. It's startling. And if you look at those graphs and you really pay attention to GDP and inflation, it's extremely scary. You know, I have to throw unemployment in there. They're all scary, actually. I mean, I don't know which one's worse, because we have the conversation here quite frequently of how we know better that inflation is nowhere near 1% or 2%. And this economist, when he looks and calculates it the way the government used to calculate it back in the 80s and back in the early 1990s, he agrees with that sentiment. And when you look to calculate real GDP, which is nominal GDP minus the rate of inflation, well, when you look at it against the backdrop of 1980s and 1990s calculations for inflation, this country has not seen positive growth since 08-09. It's been negative. Real growth has been negative for a decade. That makes much more sense to me than saying we are in the midst of an economic miracle. We are in the midst of an economic disaster. And we have been. But because you can manipulate numbers and statistics, and governments are always going to change the numbers to make themselves look better. I mean, you got to get with it, people. You got to get with it. So when you look, again, at the Wilshire 5000 price index against the St. Louis adjusted monetary base, and I index this back to 2009, January of 2009, because, well, that's when we were in the recession. That's when you really started to have quantitative easing starting to take shape, and you have this step-like graph taking place. You see it visually. And this is in our book as well, The Cynic's Guide to Investing. We talked about this step-like graph taking place. This is why we stress in the book and why I stress to you guys, if you're going to look at data, you have to graph it. You have to. Because looking at all these numbers, your heads are just going to spin. They just are. I mean, it's just how the human mind works. Make a picture. That's why I talk about an economic puzzle here all the time. Paint a picture. Put one together. If you put a graph together, that is an actual picture. And now you can start to make sense of all of those numbers and digits on a screen. Well, this one paints a very vivid picture that this stock market has been bought and paid for by the Federal Reserve, which is on the backs of you and me. Because they don't just give this money out for nothing. They give it out at interest. So we have to pay that interest through our tax dollars. You see how this system works? You're not really working for yourselves. You think you are, but you're not. You're working for the central bank. You're working for the bankers. You're working for Uncle Sam. That's why it's very difficult for people to get ahead. That's why 78% of Americans are living paycheck to paycheck. That's why the vast majority of Americans couldn't come up with $400 cash in the event of an emergency. Because you're not going to work for you and your family. You think you are, but you're not. You're going to pay the central banks, the banking system, and Uncle Sam. Why do you think they have all the money? It's all your money. You would be rich. You would be wealthy. Look at what comes out of your paycheck every week, every 2 weeks. It's disgusting. Does it make you mad? I bet it does. How much debt do you have to go into because the government takes all that money from you? How many of you are stretched thin on your credit cards? 7 million Americans 90 days plus past due on their auto loans. Not a good picture in this economic miracle we're supposedly in the midst of. Record credit card debt and delinquencies on the rise. Not good. Mortgage debt, where it was back pre-crisis. Not good. $1 trillion federal deficits. Not good. A $4.75 trillion budget proposed by the White House with $1 trillion deficits as far as the eye can see. Not good. When are these people going to wake up? You want to keep paying for this stuff? I don't. I am a millennial. All of these things that have been promised, I didn't vote for any of this crap. But I got to pay for it. I don't want this crap. But I still have to pay for it. How is that right? How is that moral? How is that ethical? And then you have a lot of people blaming my generation for this. We didn't vote for it. How is it our fault? This guy doesn't want it. But we all have to pay for it. And the people who continue to vote for this nonsense that's bankrupting this country, that is destroying progress and opportunity for people, are going to get it. A lot of people are going to get their Social Security checks. A lot of people are going to get their Medicare and Medicaid. Is Social Security going to be there for me? Medicare going to be there for me in 30-some years? Plus, what will likely happen is it will get pushed out even further. So it won't be 62 or 65 years old. It'll be 70, 72, 75 years old. Doesn't solve the problem. All that takes is a little bit of arithmetic to figure that one out. But we don't have leaders in this country that are going to structurally solve any problems. Instead, we're going to have a president who, only God knows what reason, wants to take ownership for a bubble economy and a bubble stock market, and now wants to have a debate that the Republican Party should be the party of health care. There are no structural reforms in anything taking place. There's no draining of the swamp anywhere. What is going on? Where's the debate? Where's the discussion? We have an economy and a stock market completely propped up by funny money. Does anybody care? No, because as long as you're getting richer, and again, this is mainly people on Wall Street and people with a lot of money in a 401k or in a retirement account or in a trading account who are benefiting from this. I mean, the president wants to go out there and say, your 401ks have never been higher. Yeah, for them. How many people have 401ks in this country? Not many. Not many. Most people work for small companies, and a lot of small companies don't offer it because a lot of small companies have people working for minimum wage. I mean, it's just something that they're not typically going to offer their employees. They're not going to be able to make contributions to match. Just not something that they're going to do. And then a lot of people who do have the option, they don't take advantage of it. And then the people who do have them, most of them don't have that much money in it. And then you have to understand, well, you have to work for a company for so many years to become vested for all of that money to be yours. Or at least what was matched by the company. So you have a whole bunch of people who don't have them, 401ks. You have a whole bunch of people who have 401ks who don't have that much money in them. And then it's a 401k. You can't go into that like it's your personal piggy bank or bank account. You go in and you take that money out before retirement, you're taxed. you're fined. You're paying penalties. It ain't life-changing money for these people. So why the president is all about this is beyond me, except that it's ego and arrogance. That's all it is. It's foolishness. Completely 180 from candidate Trump. Completely. I don't know what advisor suggested this or allowed him to go out and say this. Of course, a lot of people say, well, that's not President Trump. President Trump does what he wants to do. Ha, 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 ha. No, it's not funny anymore. It's not funny. Because let me give you a little dose of reality. Quite potentially, and this is consistent with what I've been saying since I've started this show, as well as being in the book, Cynic's Guide to Investing. The market will solve this. So if you look, again, back to these graphs, back to the Wilshire 5000 against the monetary base, indexed back to 2009. Again, because that's really when you started to we were in the midst of the recession and you had quantitative easing starting to take place. So if you were to make the argument that this economy, this stock market in particular, being propped up since this time, 2009, well then, when this thing pops and bursts, it makes logical sense that it will go back to where it started. So if you go back to 2009 levels within the stock markets, if you look at the Dow, if you look at the S&P, if you look at the NASDAQ, if you look at the Russell 2000, you are talking about a 75% decrease, a 75% loss. You want to eat a 75% loss? I mean, I was just telling you guys the other day, everybody's hooting and hollering at the first quarter of 2019 is reminiscent of 1998, which was in the midst of the dot-com bubble. Everybody was great. Everybody was making money hand over fist. I said, fine, you want to go back there and make that happen and have some sort of blow-off top in these markets, go ahead. Are you ready for the 80% decline? Are you ready for it? How many of you are close to retirement? Can you take that ding? Can you wait around for more quantitative easing to come save you? Because it's not going to be effective next time. Because everybody's going to say, well, we've been conned, we've been defrauded. It didn't work. So why would we use that as another solution? Why would we think that'll work again? It won't. See the problem? See the problem? You want the joy or you're going to take the pain. Because the pain's coming. And again, I don't want to be the bearer of bad news, but I'm not here to lie to you. This is what is likely to happen. Now, it doesn't mean it's going to be an 80% drop overnight. It wasn't an 80% drop overnight in 2000. It took a couple years to get down to that point. But nevertheless, is that what you want to happen to your portfolio? It lose 80%? I mean, at this point, it's a runaway train. There's nothing we can do about it. Nothing we can do about it. I mean, you want to go out and print even more money, it'll cause even more inflation. It'll cause more risk-taking that otherwise would not have happened, which will just create more and more problems, kicking the can down the road. More share buybacks, more corporate debt, more government debt, more personal debt, household debt, everything. Nobody wants to have a serious conversation and say enough's enough. Why? Because everybody likes the euphoria. Everybody wants to sell something. Everybody wants to look smart by saying, look, I managed all your money. You didn't do anything. The central banks did it. The central banks did it. They printed money. The money was going to go somewhere. It went to the banks first. The banks can play and they can gamble. They can go into the stock market. That's exactly what they did with it. They give it to bigger corporations. The corporations went out on a limb and said, oh, well, we got all this free money. It's basically for nothing. Let's buy back our shares with it. It'll make our earnings look better. How am I compensated? Oh, yeah, if the stock price increases. Well, what makes stock prices increases? Better earnings? Oh, big surprise that that's what took place. Not a whole bunch of job creation, but a whole bunch of share buybacks. So the top, the upper echelon in these companies can make out like bandits because they don't care about you and me and everybody else. They have their country club lives, which is fine. Again, I'm not demonizing it. But when it's at the expense of everybody else, when it's from a fraud, I got a big problem with it. Big problem with it, and so should you. Somebody wants to outwit, outcompete, outprice, all that good stuff in a free market capitalistic system, they should reap the benefits and the rewards. But if it's because some idiots in Washington, D.C. want to distribute money either through taxation and transfer payments or through funny money, printing presses, I got a big problem with it. And that's what this channel, that's what this podcast is all about, crusading against this. Because this is destroying and has destroyed the republic. There ain't free market capitalism in this country, ladies and gentlemen. Wake up. Wake up. We have been overtaken and have been for decades. It's just coming to the point where it's starting to really spiral out of control. And you have a president coming to terms with the fact that he made a big mistake taking ownership of this economy and the stock market. And now he and his economic advisors are out there telling the Federal Reserve to cut interest rates even more so we can keep this bubble going because, oh my God, if it goes down during an election cycle, we're going to lose. Well, you didn't have to box yourself in, but you did. But you did. Huge mistake. And now we are setting up for a 75% decline. And remember, I tell you guys, negative shocks are asymmetric. They are always worse than positive news, okay? Positive news, okay, yeah, it goes up a couple percent, 5, 10%. Negative news, it'll drop 20, 25%. I mean, that's just what it does. It overshoots. It overshoots to the upside. It overshoots to the downside. Typically, it overshoots to the downside to a greater degree than it does to the upside. So if you're going to say, all right, well, we're going to go back to 08, 09, that's 75%. Well, it might go down 80%. I'm not going to be surprised. I'm honestly not going to, but that's the opportunity of a lifetime because the companies, the corporations that still exist after that type of a beating, those are the companies you own and hold for a very long time. A very long time, especially if they're paying dividends, because you'll make out like a bandit over time with compounding interest and all that stuff. So you got to be patient. If you've made profits, don't be excessively greedy here. You've made some money, good for you. Put it in your pocket. Get it into cash. Get it into some safer instruments. Get it into some really high-grade corporate bonds. Like an ExxonMobil, like a Royal Dutch Shell. Somebody that got a lot of strong cash flow. A lot of strong cash flow. Maybe even some government bonds for the short term. But look out for stocks because they are dangerous. I'm telling you, they're dangerous. How much more to the upside can this thing go? I mean, maybe it will rally to new highs. I never said it wouldn't. Never said it wouldn't. It's always a possibility. Always a possibility. And we have central banks continuing to print money. Because when you look, again, at these graphs, when the monetary base starts to decline, this is when you start to see the stock market decline. Oh, what a surprise. But guess who came to the rescue if you look at other central banks? Well, you have the Bank of Japan that said, oh, my goodness, the U.S. is starting to go down. We need to step it up. So the Bank of Japan comes in, and so does the ECB, the European Central Bank. When the U.S. starts to dip, to the upside, Bank of Japan steps in, and ECB. What a coincidence. What a coincidence. Don't tell me this market ain't fixed. Look at the data yourself. Ladies and gentlemen, thank you so much for joining me today. It's been a pleasure having you as always. Please like, share, subscribe, get the word out. Leave your comments. I'd love to hear from you. This is the Capital News. I am Alex Kreitis. Godspeed.